In this video, I'm going to read my new paper, The Fed Funds Risk Premium After the Silicon Valley Bank Run and the Bank Term Funding Program. Subscribe to the Linus Wilson channel. I sometimes put my research on here, so some of you may know, probably most do not, that I'm a finance professor. That's my day job. And I do academic research. I've done a lot of academic research into the Fed's emergency lending programs, and they have a new emergency lending program that they rolled out after Silicon Valley Bank and Signature Bank failed in the same weekend, and they ended up bailing out the depositors. So, these were runs of uninsured depositors. What depositors at a bank are uninsured? Those are people that have accounts over $250,000. So that's probably not going to be most people watching this. So I wouldn't worry about your bank account. You'll be fine regardless of whether there's a systemic risk exemption or not. I would love to have the problem of having a bank account over $250,000, but I don't. And I think most of you listening will be in the same boat. So, but this is the Fed's attempt to try to stabilize the banking system, which does have, in terms of the banking liabilities, uninsured deposits are relatively big. I think in the paper we cite a source that says about 45% at the end of December 2022. So as interest rates have gone up, it's been harder for banks to hold on to their uninsured depositors, and the failure of Signature and Silicon Valley Bank, the rapid failures, have only accelerated that, even though uninsured depositors didn't take any losses in either one of those because of the systemic risk exemption. But the point of this paper is to say that the Fed's program, their emergency lending program, creates a strange incentive for banks to hoard treasuries, and I think it may even give them an incentive to buy more treasuries, regardless of what they think the interest rate effect will be, and also probably it gives them incentives not to hedge them. If the demand for treasuries goes up, if the supply of treasuries goes down, the price of treasuries goes up, and the yields on treasuries go down. So that's going to reduce the cost of borrowing for everybody when the treasury rates go down. And so while the Fed is saying on one hand that they're trying to reduce inflation, and they stayed pat on interest rates right after the bank failures of Silicon Valley Bank, and then they actually raised a quarter point in their next meeting, my paper says that was actually not enough, given that with one hand they're encouraging people to hoard treasuries, and they're creating a risk premium difference between treasuries and their monetary policy rate, which is the Fed funds rate, which is an overnight unsecured rate between banks. So people post this crisis are a little bit more worried about the safety of lending to a bank, and those overnight loans, while they didn't have any movement upward until the scheduled FOMC rate hike on the 23rd, or the scheduled meeting, don't know if they'll hike or not, but the treasuries have really rallied since this program happened, and I think part of that is just these incentives created by the program to take banks out of the market. They're multi-trillion-dollar buyers of treasury securities as part of their asset portfolio. So if you'd like, I'm going to read the paper to you here, but if you'd like to download it and look at the paper, especially the tables, at your leisure, then you can go to linuswilson.com or financeprofessor.org, go to the research section, and this paper will be kind of at the bottom of my research page. There'll be a link to the paper in the description of the video. But I'll show you, what you need to do is you don't need to create an account, I don't think, but you just need to click download twice. So that's the tricky part here. So you go to download this paper, and there you go. So maybe you only need to do it once. And it should have come up there, and you can look at all the tables and stuff. All right, so I'm going to read the paper to you. Thanks for watching. Subscribe if you want to. Better yet, just download the paper. All right, here we go. The Fed funds risk premium after the Silicon Valley Bank run and the Bank Term Funding Program by Linus Wilson. We find the emergency lending program introduced on March 12, 2023, called the Bank Term Funding Program, BTFP, coincided with a statistically significant increase in the risk premium on Fed fund loans relative to the shortest term T-bills. We find the risk premium on Fed fund loans less 28-day T-bills increased by 39 to 56 basis points in the wake of the Silicon Valley Bank and Signature Bank runs. This led to a stealth loosening of monetary conditions without a Fed funds rate cut, in part due to the incentives created by the BTFP to have banks hoard Treasuries and other eligible collateral. Introduction. Section 1. On March 12, 2023, the Federal Reserve Fed announced it would lend up to a year to depository institutions in their new emergency lending program entitled the Bank Term Funding Program, BTFP. The second and third largest depository institutions to fail in U.S. history had been seized after massive and rapid bank runs just days or hours before the BTFP announcement. SON 2023 reports that Silicon Valley Bank, SVB, had deposit outflows of $42 billion on March 9, 2023, and it had requests for another $100 billion of deposits on March 10, 2023, when it was closed down by California regulators. Grunberg says the Federal Deposit Insurance Corporation, FDIC, was appointed receiver on March 10, 2023 for the $209 billion in total assets SVB based in California and the $110 billion asset New York-based Signature Bank on March 12, 2023. Grunberg 2023 said both banks had unusually large uninsured deposit bases, with uninsured deposits accounting for 88 and 90% respectively of total deposits. Both failed banks had some unrealized mark-to-market losses from rising interest rates that reduced the value of their securities portfolio. Grunberg said that roughly one-fourth of U.S. bank equity could be wiped out if their $620 billion of losses on securities at the end of 2022 were mark-to-market. Much of those losses were on risk-free U.S. Treasuries and agency mortgage-backed securities exposed to duration or interest rate risk. The Bank Term Funding Program allowed banks to borrow an amount of money equal to the par of their U.S. Treasuries and agency securities. This created an incentive to own and not sell Treasuries. This paper shows that after the BTFP was implemented, there was a statistically significant risk premium with over 99% confidence that previously did not exist between the effective Fed funds rate and the 28-day T-bills. We find that after controlling for maturity and interest rate expectations, this new Fed funds risk premium increased by 48 basis points after the BTF lending began. The additional risk premium on Fed fund loans over T-bills was between 39 to 56 basis points with 95% confidence. We also find large and statistically significant spikes in the Fed's balance sheet, bank borrowing, deposit outflows, and money market mutual fund inflows after the bank runs at SVB and Signature. The implications of this new Fed funds risk premium was that, contrary to conventional wisdom, monetary conditions eased in the days immediately after the BTFP implementation, when there was no cut in the Fed funds monetary policy target rate. Lower Treasury yields reduced the cost of borrowing for corporations and households. There is already a sizable and growing literature on the Silicon Valley Bank collapse and its implications for financial markets and the banking sector. Nevertheless, we can find no studies analyzing the impact of the Federal Reserve's Bank Term Funding Program as the present paper does. Further, we cannot find any studies on how the aftermath of the Silicon Valley Bank collapse coincided with an increase in the risk premium on Fed funds loans relative to Treasuries, as we have documented here. Pandy et al. 2023 found that the global stock indices experienced negative and significant abnormal returns in the days that followed the Silicon Valley Bank collapse. Allen et al. 2023 argue that the two failed banks' uninsured depositors and balance sheet risks were unique and did not represent an underlying systemic risk to the banking system. Zhang et al. 2023 show that the number of potential bank failures in 2023 is a function of the cost of meeting deposit requests. Metric and Schmelzing 2023 find that the policy responses to these two bank failures, ad hoc deposit account guarantees, and broad-based emergency lending, were unique relative to similar banking crisis episodes. Bales and Berghoff 2023 look at intraday returns, and they find Twitter tweets were associated with negative excess returns to Silicon Valley Bank prior to its collapse. Diamond and Dybvig highlight how just a small risk of bank failure can set off a self-fulfilling depositor run without deposit insurance protections. While uninsured depositors were ultimately bailed out at Silicon Valley Bank and Signature Bank, uninsured depositors did not know that prior to the banks being seized by the FDIC in receivership. No depositors, insured or uninsured, suffered losses at either bank. Their shareholders and bondholders were wiped out in the FDIC receivership, and the Deposit Insurance Fund incurred $22.5 billion in losses, according to Grunberg 2023, after the systemic risk exemption was triggered. The systemic risk exemption was triggered for both SVB and Signature banks by unanimous votes of the relevant boards of the FDIC and Federal Reserve in concurrence with the Secretary of the Treasury in consultation with the President of the United States. While the uninsured depositors were protected in SVB's and Signature's failures, the Fed, the FDIC, and the U.S. Treasury were unable to provide systemic risk exemptions for uninsured depositors at other banks, which had not yet failed because the Dodd-Frank reforms outlined in Vergara. Losses to the Deposit Insurance Fund from the systemic risk exemption are paid for with a special assessment on FDIC-insured banks by law. Vergara explains that the Dodd-Frank Act prohibited the FDIC from providing system-wide guarantees like it did during 2008 to 2012. The FDIC announced the Transaction Account Guarantee Program, TAGP, on October 14, 2008, which was extended to December 31, 2012. The TAGP provided unlimited deposit insurance to non-interest-bearing transaction accounts. Davidson 2019 found at its peak that it insured $834 billion of deposits. That was far from a universal deposit guarantee, and Hayes 2023 found that 45.9% or $7.9 billion of U.S. banking deposits were uninsured by December 31st, 2022. In Section 2, we discuss our data sources and propose two hypotheses. In Section 3, we show that the Fed funds rate and 28-day T-bill were joined at the hip prior to the Bank Term Funding Program. After its implementation, a large and statistically significant risk premium opened up for both the Fed funds and LIBOR versus the 28-day T-bill, supporting hypothesis 1. In Section 4, we find support for Hypothesis 2 that the Fed funds balance sheet, aggregate bank borrowings, direct borrowings from the Fed through the discount window, and money market mutual fund assets rose significantly while aggregate deposits fell significantly in the weeks after the bank runs at SVB and Signature Bank. In Section 5, we conclude and discuss why the BTFP may be a monetary loosening in the short term, but may contribute to a contraction of credit in the medium to long term. Data. We obtained yields on the 28-day T-bill and the 2-year and 10-year T-notes from the U.S. Treasury. The 1-month LIBOR yields were from MarketWatch and the Costa Rican Central Bank. The LIBOR is the London Interbank Offer Rate. The LIBOR is the London Interbank Offer Rate is the interest rate on euro-dollar deposits in money center banks in London which are not FDIC insured. Effective Fed funds rates were from the St. Louis Fed. The Fed funds rate is an overnight unsecured loan between commercial banks for reserves. Since the late 1980s, it has been the primary monetary policy target rate for the Federal Reserve. Chicago Board of Trade CBOT 30-day Fed fund futures for April 2023 delivery were obtained from investing.com. The expected 28-day Fed funds interest rate on date T, FF28 sub T, is a weighted average of the effective funds on the day, EFFT, and the April 2023 Fed funds future implied rate, FFA sub T. There was no scheduled Federal Open Markets Committee FOMC meeting in April 2023, thus the implied rate is the post-March 22 target rate announcements effective Fed funds expected by futures traders. Let DT be the number of days until March 22, 2023, the second day of the FOMC meeting when policy rates are announced. FF28T equals DT over 28 times EFFT plus the quantity 28 minus DT divided by 28 times FFAT. The expected 28-day Fed funds futures interest rate, FF28T, is meant to control for the fact that the 28-day Treasury yield has interest rate expectations for 28 days, not just overnight as with the Fed funds loans. Fed funds futures are not an unbiased predictor of the Fed funds rate at delivery according to Piazzi and Swanson 2008. Nevertheless, equation 1 partially adjusts for the term structure of interest rate expectations embedded in the 28-day T-bill by putting those expectations in the constructed 28-day Fed funds rate. The BTFP dummy equals 1 if the bank term funding program was active. The Federal Reserve 2023B announced the BTFP program after the failures of Silicon Valley Bank and Signature Bank on Sunday, March 12, 2023. At the same time, the insured depositor of those two failed banks were protected from losses with the systemic risk exemption invoked by the FDIC, Federal Reserve, and the U.S. Treasury. Dates prior to March 12, 2023 have the BTFP dummy coded 0, and after that date, the BTFP dummy is coded 1. The BTFP charged the 1-year overnight index swap rate as of the day the advance is made plus 10 basis points according to Federal Reserve 2023A. On April 8, 2023, FRB discount window said that rate was 4.69%, with the Fed funds target rate was 4.75 to 5.0%, and the discount window primary credit rate was 5%. While this rate may have been favorable relative to the discount window or Fed funds rate on that day, the BTFP interest rate would have been in excess of the coupons on underwater Treasury or agency collateral that was purchased when interest rates were lower. The BTFP allowed depository institutions to post U.S. Treasury and agency securities and obtains loans of up to 1 year for an amount equal to the par of the collateral posted. Thus, banks that had U.S. Treasury or agency securities that lost value due to rising interest rates could obtain the maturity value of those securities and loans to stem deposit outflows. These BTFP loans had more generous terms in the discount window, which took haircuts on collateral and limited loans to 90 days, according to Federal Reserve 2000A. There are no weekend observations. We looked at 2 time horizons with daily data. We looked at the 253 trading days from March 17, 2020 to March 2022 to March 22nd, 2023 first. That is the start of the Federal Open Market Committee's FOMC's hiking cycle that began with the March 17, 2022 25 basis point hike to the Fed funds rate target of 0.25 to 0.5%, according to Tepper 2023, until just prior to the announcement of the 25 basis point Fed funds hike to a target of 4.75 to 5.0% on March 23, 2023. Basis points are 1/100th of a percent. Thus, we will look at the interest rate data for just over a year from March 17, 2022 to March 22, 2023, which had effective Fed funds rates between 0.33% and 0.58%. Over the hiking cycle, the Fed funds was on average 1 basis point less than the 28-day T-bill. The median observation of the Fed's funds being 3 basis points less than the shortest maturing U.S. Treasury security. The 2-year Treasury note yield was on average 54 basis points less than the 10-year Treasury note, with a median of 51 basis points less than the 10-year. Thus, for most of this year or so of rate hikes studied, the yield curve was upward sloping as measured by these 2 U.S. Treasury note yields. Hypothesis 1. The Bank Term Funding Program created or coincided with factors that raised the price of treasuries and raised the risk premium on overnight loans to depository institutions. The net result was the spread between A, the effective Fed funds rate less the 28-day T-bill yield, and the B, 1-month LIBOR less the 28-day T-bill yield increased after the BTFP was announced. Here is a list of reasons why we think hypothesis 1 is true. The BTFP increased the demand for treasuries as commercial banks were immunized from losses from unexpected interest rate increases because they could borrow off treasury collateral at par. The BTFP decreased the supply of U.S. treasuries as banks could fund more deposit outflows with BTFP loans than selling treasuries worth less than par. After the second and third largest bank failure in U.S. history, unsecured loans to banks such as Fed funds or LIBOR were perceived to be riskier. Longstaff 2004 documents the flight to quality premium of treasuries. U.S. treasuries would benefit from a flight to quality rally and a fall in yields as a banking crisis seemed more likely. After the large bank failures which exposed uninsured depositors to potential losses, many depositors were incentivized to move to money market mutual funds that invested in U.S. treasuries or direct investments in treasuries, driving down treasury yields. Finally, interest rate hikes from the Fed would be perceived to be less likely after the bank failures, and the 28-day treasury yield would reflect that lower March 23, 2023 Fed funds rate hike chance. Unfortunately, we only have weekly data on the Fed's balance sheet total assets, aggregate borrowings, total discount window borrowing, total bank term funding program borrowing, and total net assets from the U.S. money market mutual funds, MMFS. Total assets of the Federal Reserve, the Wednesday level, weekly, not seasonally adjusted, borrowings from all commercial banks, weekly, not seasonally adjusted, and deposits from all commercial banks, weekly, seasonally adjusted, are from the St. Louis Fed, FRED. The weekly Wednesday level discount window and BTFP lending to banks is from the H4.1 data from the Federal Reserve. The total net assets of U.S. money market mutual funds were reported by the Investment Company Institute. The weekly change in the Fed's balance sheet assets, bank borrowing, discount window, and BTF combined borrowing, total deposits, and money market mutual funds was the current week's level less the prior week's level, which was divided by the prior week's level. If the level at time t was denoted by LT, then the change was LT minus 1, all in brackets, divided by LT minus 1. We collected data just prior to the FOMC's first rate hike of 2022 on March 16, 2022 to March 22, 2023, just prior to the 4.75 to 5.0% Fed funds target announcement on March 23, 2023. Since we lose an observation for change data, the first weekly change was for March 23, 2022. The time series for the Investment Company Institute for money market mutual funds was more limited and began on November 2, 2022. The levels were all Wednesday levels. Hypothesis 2. After the launch of the Bank Term Funding Program and the failure of Silicon Valley Bank and Signature Bank, A, the Fed's balance sheet assets, B, bank borrowing, C, discount window plus BTF borrowing, D, total U.S. money market mutual fund assets will rise, and E, deposits will fall. We are predicting that the bank runs and BTFP program used to combat it will require the Fed to increase its balance sheet to support deposit outflows. Depositors will respond to the increased perceived risk and scrutiny on the interest rate gaps between bank deposits and money market mutual funds by withdrawing deposits from the U.S. banking system post-BTFP. Banks will increase their borrowing and total borrowing and discount window and BTF borrowing to meet deposit redemption requests in the days after BTFP was announced. Alfonso et al. Found that the 3-month CD rates at U.S. banks only responded to 8% of the Fed funds hikes between March 22 and March 2023, while money market mutual fund yields increased by 97% of the Fed funds rate hikes over that period. Thus, uninsured depositors seeking yield or safety have every incentive to move away from bank deposits into MMFS after the bank runs at Silicon Valley Bank and Signature Bank. Section 3. The rising Fed funds risk premium. We are interested in how the Bank Term Funding Program affected the U.S. Treasury market. In theory, the Fed funds policy rate should affect the shortest term rate, the 28-day Treasury yield, more than any other U.S. Treasury rate. During the March 2022 to March 2023 Fed rate hiking cycle, the effective Fed funds rate explained over 97% of the 28-day T-bill rate. The coefficient for the effective Fed's fund rate is significant, with over 99% confidence in the 28-day T-bill regressions in Table 3. Model 2 in Table 3 says that a 4.57% effective Fed funds rate, which prevailed in the days before the BTFP was announced, would predict a 4.65% 28-day T-bill. After the BTFP, the model predicts that the 28-day T-bill would drop by 36 basis points to 4.29%. The coefficient for the BTFP dummy is statistically significant with over 99% confidence. Insert Table 3 about here. The 36 basis point drop in the 28-day T-bill yields after the BTFP was implemented has a 95% confidence interval of 54 to 17 basis points with a standard error of 9 basis points. Thus, if the Fed wanted to maintain the same monetary tightness after the BTFP as existed prior to it, the FOMC would have had to raise Fed funds by 36 points in expectation. In Table 4, we look at the risk premiums for short-term bank liabilities of the Fed funds and 1-month LIBOR over 28-day Treasuries during the 1-year rate hiking cycle studied. Over this period, the T-bill yield exceeded the effective Fed funds rate by an insignificant 2 basis points prior to BTFP. That means there was no risk premium for the effective funds rate prior to the Silicon Valley Bank and Signature Bank runs. After their failure, there was a statistically significant 30 basis point risk premium for Fed funds with 99% confidence. The 95% confidence interval for the post-BTFP risk premium was 11 to 48 basis points with a standard error of 9 basis points. The 1-month LIBOR is an interest rate on uninsured US dollar deposits between London banks. That risk premium over the 28-day T-bill was statistically significant with 99% confidence at 21 basis points. After the BTFP program started, the risk premium on the LIBOR rose by a statistically significant 24 basis points. Thus, on average, post-BTFP, Model 2 of Table 4 predicts that the 1-month LIBOR spread over the 28-day T-bill rose to 45 basis points. Insert table about 5 about here. In Table 5, we look at interest rate measurements in the 34 trading days between the February 1st, 2023 FOMC rate hike and the announcement of the March 23rd, 2023 rate hike. Over this period of February 2nd, 2023 to March 22nd, 2023, the Fed funds target rate was 4.5 to 4.75%. The BTFP dummy was statistically significant in all regressions. It was significant with over 99% confidence in all models except Model 2 with the effective Fed funds rate as the dependent variable. The policy target, the effective Fed funds rate, ticked up less than a basis point with 95% confidence. Treasury rates dropped significantly with over 99% confidence as predicted in Hypothesis 1. The 28-day T-bill yield dropped by 38 basis points in Table 4 Model 1, in line with the longer time series estimates in Table 3 Model 2. Table 5 Model 6 estimates the Fed funds spread over the 28 estimates that the Fed funds spread over the 28-day T-bill widened by 38 basis points after the BTFP and bank runs. Prior to that, it was negative 4 basis points with 90% confidence. With the T-bill yielding more than the effective Fed funds, the 1-month LIBOR risk premium spiked by a statistically significant 48 basis points in Model 7. Also increasing with 99% confidence were the 2-year less the 10-year note spread and the Fed funds less the 10-year note spread. These results are all consistent with Hypothesis 1, Parts A and B. To control for changing expectations of the rate hike probabilities, we use the April 2023 Fed Fund futures. These reflect the market's expectations of the post-March 23rd, 2023 FOMC announcement effective Fed funds rate. After adjusting for the term structure prior to BTFP, the 28-day Fed funds rate from equation 1 was 5 basis points less than the 28-day T-bill, which was significant with 95% confidence. After the bank runs and the BTFP program, the risk premium on the Fed funds over the 1-month T-bill jumped by 48 basis points according to Model 6 of Table 5. That increase was statistically significant with 99% confidence. The basis point spread of the expected 28-day Fed funds less the 28-day T-bill increased by 39 to 56 basis points with a standard error of 4 basis points. Thus, the Fed would have had to hike by 48 basis points on March 23, 2023 to offset the effects of the Bank Term Funding Program and the flight to quality. The rate hike was 25 basis points on March 23, 2023. Section 4, the contradiction of a bigger balance sheet and no Fed funds rate cut. One thing that reinforces the decreasing relevance of the Fed funds rate as a measure of policy tightening is the simultaneous rise in the Fed's balance sheet while the policy rate was unchanged. Open market operations dictate that the Fed should sell Treasuries to tighten policy. The increasing spread between the yields on the Fed funds due to the bank risk premium Treasury price support by the discount window and bank term funding program lending, and the flight to quality meant the Fed could loosen monetary policy in the weeks after the BTFP and maintain the same effective Fed funds rate. We argue that the growth of the balance sheet and declining Treasury yields may be a better indicator of loosening monetary policy in the short term than the effective Fed funds rate. In Model 1 of Table 6, we see the trend from March 23, 2022 to March 22, 2023 was a decline in the Fed's balance sheet by 0.1% per week, which was statistically significant with 99% confidence. At the same time, the balance sheet ballooned by 2.5% per week after the BTFP was enacted. The BTFP dummy is statistically significant with over 99% confidence. In Model 2 of Table 6, we see that with 90% confidence that there was a negative relationship with the effective Fed funds rate and the Fed's balance sheet. A 1% higher effective Fed funds rate was associated with a weekly decline in the balance sheet of 0.1%. The BTFP dummy is positive and significant in both Models 2 and 3 with 99% confidence. In Model 3 of Table 6, we also find a negative and significant relationship with 90% confidence between the weekly change in the Fed's balance sheet and the 28-day T-bill yield. These results in Table 6 support hypothesis 2A. Insert Table 7 about here. In Table 7, we show that bank borrowing, direct loans from the Fed to depository institutions, and money market mutual fund (MMF) assets increased significantly in the weeks after the bank runs and the BTFP was implemented, with over 99% confidence. With over 99% confidence, U.S. deposits declined by 0.8% per week after the bank runs of Signature and Silicon Valley Bank. The percent of these average weekly moves after the BTFP was announced are huge. Total bank borrowings grew 13.3% per week after the bank runs. Direct borrowing from the Fed through the discount window and BTFP grew by an average of 1,726.8% per week after the BTFP was announced. There was a 2.1% per week growth of the money market mutual fund total assets after BTFP. Simply put, U.S. banks had to borrow a lot of money to pay for deposit flight right after the second and third largest commercial bank failures in U.S. history in March 2023. Many of those deposits went into money market mutual funds. The results in Table 7 support hypothesis 2 parts B, C, D, and E. Conclusion. In this paper, we have shown that a large and statistically significant risk premium opened up between the Fed funds rate and the 28-day T-bills after the bank term funding program was rolled out on March 12, 2023. This emergency lending program was meant to prevent devastating bank runs similar to those that toppled the $209 billion and $110 billion Silicon Valley Bank and Signature Bank, respectively. We argue that the bank term funding program created incentives for banks to refuse to sell treasuries, which translated into lower treasury yields. The new lending program may have contributed to a statistically significant 48 basis point increase in the spread between the effective Fed funds rate and the 28-day Treasury bills that opened up in the days after the BTFP started lending to depository institutions. This was a stealth monetary loosening without a Fed funds rate cut, which has been rarely discussed. The Fed funds target rate was able to be changed while there were large statistically significant increases in the Fed's balance sheet of mostly Treasury and agency securities in the days after the failures of SVB and Signature. Since the tight relationship between the Fed funds rate and the 28-day T-bills may be broken post-BTFP, policymakers may want to look at other interest rate metrics to see if their monetary policy is inflationary or contractionary. While the BTFP and flight to quality was stimulative in the short run because They led to reductions in the risk-free rate and thus the cost of borrowing for businesses and households. Its long to medium-term effects may be contractionary. Banks borrowing from the Fed will have less money to lend. Tightening of loan standards through the Senior Loan Officer Survey has been shown to be predictive of future declines in GDP by Loan et al. 2000, Loan and Morgan 2006, and Cunningham 2006. Chava et al. 2015 and Wilson have even found that rising loan standards may even predict falling stock returns. Thus, Treasury and agency security hoarding by banks will mean lower growth in lending and investment in the medium to long term.